Apple may have just changed the Nasdaq story. Everyone has been watching Nvidia. Everyone has been watching AI cloud stocks. Everyone has been asking the same question. Is the Nasdaq rally already too crowded? But Apple's earnings just gave the market a different answer. Maybe this rally is not over. Maybe it is rotating. Maybe the next leg is not only about GPUs and data centers. Maybe the next leg is about AI devices, iPhones, semiconductors, memory, consumer hardware, and the Apple supply chain. If you want to catch these breakouts before they become obvious, subscribe to Stock Breakout, hit like, and drop your strongest watch list ticker in the comments. Because retail usually finds these rotations late. This channel is built to find them early. For most of this AI bull market, Apple has not been the star. Nvidia was the star. Palantir became one of the biggest AI hype names. Microsoft, Amazon, Meta, and Google became the AI infrastructure giants. Broadcom became a key custom silicon winner. Data center stocks exploded. Power stocks exploded. Cooling stocks exploded. But Apple spent a long time looking like the AI laggard. That is why this earnings report matters. When a stock like Apple starts to wake up after being ignored, the market pays attention. Because Apple is not a small company. Apple is not a speculative AI name. Apple is one of the biggest weights in the Nasdaq. So if Apple starts catching up, it can change the entire index story. That is the traffic hook. But the real opportunity may be hiding one layer deeper. Because Apple's earnings are not just about Apple. They may be about the next phase of the AI trade. The device phase. The consumer hardware phase. The supply chain phase. And that is where retail may be late. Here is the big judgment. The AI trade may be moving from the cloud to the pocket. The first phase was data centers. GPUs. Networking. Servers. Power. Cooling. That phase was led by Nvidia and the AI infrastructure chain. But the next phase may look different. It may be about bringing AI directly onto devices. Phones, laptops, wearables, edge chips, memory, connectivity, and high-performance consumer hardware. That is why Apple matters right now. Apple does not need to look like Nvidia to move the market. Apple only needs to prove one thing. The AI device cycle is real. If the iPhone 17 cycle is strong, and if services keep hitting records, and if Wall Street believes Apple can turn its installed base into an AI platform, then Apple may not stay a laggard forever. The market is missing this. This is not just a stock story. This is a market rotation story. If Apple starts moving, the Nasdaq rally can broaden beyond the obvious AI winners. And when the rally broadens, second-order names can move before most retail investors understand why. Let's start with the anchor. Apple. Ticker Apple. Apple is the most important name in this setup because it gives the entire rotation credibility. The company sells iPhones, Macs, iPads, wearables, and services. Everyone knows that. But the market has been treating Apple like a company that missed the first AI wave. That may now be changing. The strongest upside logic is simple. Apple does not need to win the data center AI race. Apple needs to own the consumer AI interface. That means the device in your pocket. The operating system you use every day, the apps, the payments, the subscriptions, the ecosystem, the identity layer, the privacy layer, the installed base. That is where Apple has power. And this quarter gave Wall Street several reasons to take that power seriously again. First, iPhone 17 demand looked strong. That matters because the iPhone is still the center of the Apple ecosystem. If the iPhone cycle is strong, Apple has more room to sell AI features, upgrades, accessories, subscriptions, and services. Second, services revenue hit a new all-time high. That matters because services are high-quality revenue. They're sticky. They are recurring. They show that Apple is not just a hardware company. Third, guidance looked optimistic. That matters because Wall Street does not only price what happened last quarter. Wall Street prices what may happen next. Fourth, the buyback is massive. That gives investors a direct capital return story. A strong business plus a huge buyback can create a powerful support structure for the stock. The breakout trigger for Apple is simple. If investors begin to believe that Apple's AI device cycle is real, the multiple can re-rate. Not because Apple suddenly becomes Nvidia, but because the market stops treating Apple like it missed AI. The risk is also clear. Apple still needs to prove that its AI strategy can excite consumers and developers. If the product cycle disappoints, the stock could lose momentum. But here is why the setup matters. Apple has been less loved than the obvious AI leaders. When a mega cap laggard starts to catch up, the move can pull huge index money with it. That is why smart money is already watching. Now let's move one layer deeper. Broadcom. Ticker Broadcom. Broadcom is one of the cleanest second-order names in this Apple and AI hardware rotation. The company is not just a semiconductor stock. It is a custom silicon, networking, connectivity, and infrastructure powerhouse. For the Apple angle, the key idea is this. If consumer AI devices become more powerful, they need better chips, better connectivity, better wireless performance, and more complex semiconductor content. Broadcom has long been tied to premium device ecosystems through connectivity and wireless components. But the reason Broadcom matters now is bigger than just Apple. Broadcom already sits at the center of custom AI, silicon, and networking for the cloud. That means it can benefit from both sides of the AI trade. Cloud AI infrastructure on one side, consumer AI hardware on the other. That is powerful. The market may be underpricing this because many retail investors still see Broadcom as either a dividend compounder or a cloud AI chip play. But the real story could be broader. Broadcom may become one of the bridges between AI infrastructure and AI devices. That is the strongest upside logic. If Apple's cycle improves, and if AI device demand lifts semiconductor content, Broadcom becomes one of the names investors may look at quickly. The breakout trigger could be any combination of Apple's strength, AI custom silicon demand, networking growth, or stronger investor confidence that AI is not just a one-company Nvidia story. The risk is valuation. Broadcom is already known. It is not hidden like a small-cap stock. If expectations get too high, the stock can pull back fast. But that does not kill the setup. It just means the entry matters. Broadcom is a second-order name with first-tier credibility. And in a Nasdaq rotation, credibility matters. The next stock is Qualcomm. Ticker Qualcomm. Qualcomm is one of the more direct ways to think about the AI device cycle. The company is known for mobile chips, wireless technology, and connectivity. That makes it important if the AI trade shifts toward edge devices. Edge AI means more intelligence happens on the device itself. Not always in the cloud. Not always in a remote data center. On the phone. On the laptop. In the car. In wearables. In connected devices. That is where Qualcomm can become interesting again. Most investors are looking in the wrong place. They think AI only means bigger data centers. But if AI moves onto devices, chips inside those devices matter more. Power efficiency matters. Connectivity matters. Battery life matters. On-device performance matters. This is Qualcomm's territory. The Apple connection is more complicated because Apple has been working to control more of its own silicon stack. That is a real risk. But the broader consumer AI device theme still matters for Qualcomm. If Apple proves that consumers are willing to upgrade for AI-capable devices, then the entire premium device market may reprice. Not just Apple, Android devices, PCs, automotive platforms, wearables, connected hardware. That could pull attention back to Qualcomm. Wall Street may be underpricing Qualcomm because it has not been treated like one of the core AI winners. Retail does not usually put Qualcomm in the same sentence as Nvidia. But that may be exactly why the setup matters. The obvious trade may already be crowded. The real opportunity may be hiding one layer deeper. The breakout trigger is a stronger belief that on-device AI is becoming a real upgrade cycle. The risk is competition and customer concentration. Qualcomm still faces pressure from large customers building more of their own chips. But if the market starts rotating toward AI devices, Qualcomm could move from forgotten mobile chip name to key edge AI beneficiary. That is the kind of shift stock breakout is looking for. Next is Micron. Ticker MU. Micron is the memory name in this watch list. And memory may be one of the most important parts of the AI device story. AI needs compute, but AI also needs memory. In the cloud, that means high bandwidth memory and advanced data center memory. On devices, it means more memory content inside phones, laptops, and AI-capable hardware. If Apple's iPhone cycle is strong, and if the market starts betting on more AI features moving onto devices, investors may ask a simple question. Who benefits from more memory demand? That puts Micron back on the screen. The strongest upside logic for MU is not complicated. AI increases memory intensity. That applies to servers. It can also apply to PCs and smartphones. If every device needs more memory to run better AI features, memory makers can gain pricing power. That is why this setup matters. Micron can benefit from the AI infrastructure cycle and the AI device cycle at the same time. Wall Street may not be fully pricing that dual exposure. Retail may only see Micron as a cyclical memory stock. Boom and bust, up and down. But AI may change the quality of the cycle. Not forever, not in a straight line, but enough to make investors pay attention. The breakout trigger could be rising memory prices, stronger AI server demand, stronger device demand, or commentary from Apple and other hardware makers showing that memory costs and memory content are becoming more important. The risk is obvious. Memory is cyclical. Prices can rise fast, but they can also fall fast. If demand cools or supply grows too quickly, MU can be volatile. But that volatility is also why retail watches the stock. When the market starts pricing a memory upcycle, Micron can move hard. This is where the next breakout could begin. Not because MU is safe, because MU is leveraged to a theme that may be bigger than most investors realize. Now let's talk about TSMC. Ticker TSM. TSMC is the manufacturing backbone behind much of the advanced chip world. If the AI trade expands from data centers into consumer devices, the manufacturing layer becomes even more important. Apple relies on advanced chip manufacturing. Nvidia relies on advanced chip manufacturing. AMD relies on advanced chip manufacturing. Many AI and mobile leaders rely on advanced chip manufacturing. That gives TSMC a unique position. It does not need to pick only one winner. It sits behind many of them. For Apple specifically, the link is clear. The iPhone 17 cycle depends on advanced processors. If demand is strong and supply is tight, that tells the market that leading-edge manufacturing capacity remains valuable. That is why TSM matters in this rotation. The strongest upside logic is capacity scarcity. Advanced chips are hard to make. The number of companies that can manufacture them at the highest level is extremely limited. If AI device demand grows and AI data center demand remains strong, the pressure on advanced manufacturing does not disappear. It increases. Wall Street understands TSMC, but retail investors often chase the front-end brands first. They chase Nvidia. They chase Apple. They chase the product names. They do not always chase the manufacturing bottleneck. That is where the opportunity may be hiding. The breakout trigger for TSM could be stronger Apple demand, more AI chip orders, better pricing power, or renewed investor focus on semiconductor capacity. The risk is geopolitical. TSMC carries Taiwan-related risk, and investors cannot ignore that. But the market already knows this risk exists. The question is whether demand is strong enough to keep pulling capital back into the stock anyway. If Apple's cycle confirms that advanced chips are needed not only for cloud AI, but also for consumer AI devices, TSM becomes one of the cleanest infrastructure names behind the whole story. The final name is ARM. Ticker ARM. ARM is different from the others. It is not a traditional hardware manufacturer. It provides chip architecture that powers a huge part of the mobile and low-power computing world. That makes ARM highly relevant if AI moves toward devices. Why? Because on-device AI needs performance, but also needs efficiency. Phones cannot consume power like data centers. Laptops need battery life. Wearables need low power. Cars need specialized compute. Edge devices need chips that can run AI tasks without destroying energy efficiency. That is the ARM story. The strongest upside logic is that AI at the edge could increase the value of efficient chip architecture. If the market starts believing that the next AI wave is not only cloud training, but also inference on billions of devices, ARM could become a key name in that conversation. Wall Street may already understand ARM's strategic position, but many retail investors still do not know how to categorize it. Is it chip stock? Is it an IP stock? Is it an AI stock? Is it a mobile stock? That confusion can create opportunity. When a narrative becomes clear, the repricing can happen quickly. The breakout trigger could be rising attention on edge AI, stronger smartphone upgrade cycles, AI PC demand, or more licensing momentum tied to advanced device chips. The risk is valuation. ARM can trade with high expectations. That means any slowdown or disappointment can hit the stock hard. But for a market rotation watch list, ARM belongs here. Because if Apple makes investors care about AI devices again, ARM becomes one of the names that fits the theme fast. Now, pull the whole setup together. Apple's earnings are not just about one quarter. They may be a signal that the Nasdaq rally is changing shape. The first AI wave was obvious. Nvidia, AI servers, cloud capex, Data centers, power, cooling, infrastructure. That trade still matters. But the next wave may not look exactly the same. It may move toward devices, consumer AI, iPhones, laptops, semiconductors, memory, wireless, edge computing, and advanced chip manufacturing. That is why this watch list matters. Apple is the anchor. Broadcom gives you custom silicon and connectivity. Qualcomm gives you edge AI and mobile compute. MU gives you memory leverage. TSM gives you advanced manufacturing. ARM gives you low-power AI architecture. This is not an ordinary watch list. This is a market rotation watch list. If Apple starts catching up, the Nasdaq rally may broaden. And when a rally broadens, investors often search for the next layer of winners. Retail may be late. Wall Street is moving fast. Smart money is already watching. The window may not stay open forever. The biggest moves usually start before the crowd feels comfortable. And right now, this setup matters. Because Apple may have just proved that the Nasdaq rally is not over. It may only be rotating. If you want to catch the next breakout before it becomes obvious, subscribe to Stock Breakout. Retail usually finds these trades late. This channel is built to find them early. Hit like if this Apple rotation watch list helped you. And drop your strongest ticker in the comments. Is it Apple, Broadcom, Qualcomm, MU, TSM, ARM? Or is there another Apple supply, chain stock Wall Street, is still underpricing? I want to see your watch list. Because the next Nasdaq move may not come from the stock everyone is already chasing. It may come from the name sitting one layer deeper. That is what Stock Breakout is here to find.